Because here's what most retail participants don't understand. Sophisticated capital doesn't take weekend risk unless the alternative is worse. The easy play, the comfortable play, is to flatten positions before the close, eliminate exposure, avoid the uncertainty of 65 hours where markets operate globally, but your primary pricing mechanism is dark. So when volume accelerates into the close instead of fading, when prices hold firm despite earlier weakness, when the tape shows repeated buying at $89, $89.20, $89.40, someone is making a calculation that being flat over the weekend is more dangerous than being long. Let that sink in, because it contradicts everything about normal risk management, unless you know something the price doesn't reflect yet. Here's the framework for understanding what a gap actually represents. It's not a prediction, it's not speculation. It's a mechanical acknowledgement that the last traded price was fiction, a temporary number that existed because of timing, liquidity, and the accident of when the market closed. Not because it represented true equilibrium. Markets close at arbitrary times, 4:30 p.m. in New York, but silver doesn't stop being traded. It doesn't stop being needed. It doesn't stop being bought and sold in London, Shanghai, Zurich, Dubai. The global physical market never sleeps. And when that 24-hour market starts printing prices that don't match the frozen COMEX reference, the gap isn't being created, it's being revealed. Monday's opening bell doesn't create a new price, it simply exposes the price that already existed while New York was closed. Now here's where it gets precise. The $110 to $150 range being discussed isn't pulled from imagination, it's derived from observable stress indicators that have been building for weeks. Let's walk through them. First, physical premiums in international markets. Normally, physical silver trades at a small premium to paper futures, 2%, 3%, maybe 5%, depending on form and location. This covers fabrication, transport, dealer margins, nothing unusual. But reports over the January 18th and 19 weekend show premiums in certain markets significantly elevated, not 5%, not even 10%. Spreads that suggest physical buyers are willing to pay materially more than the COMEX reference. Why? Because they need metal, not exposure, bars, not contracts, and they need it now. Not in March, not in May, now. Second indicator, after hours block trades, late Friday, after the official 4:30 close, reports of significant institutional activity, blocks of 2,200 contracts, 1,800 contracts, 3,000 contracts, executing in the $89.40 to $90 range. This isn't retail. Retail doesn't move in 1,000 contract increments. This is institutional capital, positioning size in lower liquidity conditions, accepting less favorable pricing, because the calculation isn't about saving 50 cents per ounce. It's about not paying $20 or $30 more on Monday. If you believe Monday opens at $110, then paying $90 on Friday evening isn't expensive. It's insurance. Third indicator, borrowing costs, silver lease rates, the cost to borrow physical metal for short-term needs. Typically sit in quiet obscurity, 1%, 2%, maybe 3% annualized. But when lease rates spike into double digits, when the cost to borrow metal jumps to 12%, 15%, potentially higher, that's not casual market activity. That's distress. Someone needs to borrow metal immediately to satisfy an obligation they cannot defer. And they're willing to pay elevated rates because the alternative, failure to deliver, is worse. When you see lease rates spike heading into a delivery month, it's not a data point, it's a warning. Fourth indicator, rolling behavior. Futures market participants normally love time. Time gives flexibility. Time reduces funding costs. Time allows positions to be managed without urgency. So when participants start rolling positions backward, moving from later contract months into nearer months, giving up time, voluntarily choosing more urgency, that's abnormal. That's someone who believes waiting is more dangerous than acting. They're accelerating, not because they want to, because they believe they have to. All four indicators, elevated physical premiums, late block trading, spiking lease rates, backward rolling, are pointing in the same direction, stress. And stress in commodity markets with delivery obligations doesn't resolve gradually, it resolves abruptly. Now let's address the skeptical voice, because skepticism is healthy. Until it becomes denial. The skeptic says, silver doesn't just jump $30 overnight. Markets don't work that way. And under normal conditions, the skeptic is right. But these aren't normal conditions. Normal conditions assume liquidity is continuous, that sellers exist at every price level, that the transition from $89 to $110 would involve actual trades at $90, $100, $95, $100, $105. But what if those sellers aren't there? What if the participants who would normally sell at $95 already sold earlier in the week? What if the metal that would normally be offered at $100 is already committed, pledged, immobilized? What if the first real liquidity, the first place where substantial selling interest appears, isn't until 110? Then the market doesn't climb, it jumps. Because the opening auction mechanism has one job: find the price where buy orders and sell orders match. And if they don't match until $110, that's where the first trade prints. Not because anyone wanted it to, because that's where equilibrium exists. This is the gap, not manipulation, not irrationality. Mechanical price discovery when liquidity is discontinuous. And here's the part that separates prepared participants from casualties: the weekend. Most market participants treat weekends as downtime. Markets closed, nothing to monitor, time to disconnect. But the world doesn't stop operating. Silver doesn't stop being demanded. Industrial users don't pause their production schedules. Solar panel manufacturers don't halt assembly lines. Electronics producers don't stop needing conductive materials. Medical device companies don't suspend operations. The demand is constant, but the primary pricing mechanism, COMEX futures, goes dark for 65 hours. And during those 65 hours, narrative, on Friday. The narrative is healthy profit-taking after strong rally. If Monday gap's higher, the narrative instantly becomes silver breaking out, shortage pricing, new paradigm. Narrative drives behavior. Behavior drives capital flows. Capital flows drive price. So even if the gap starts as mechanical, inventory-driven, delivery stress-related, it can become psychological. It can become a stampede, where institutional participants who were underweight suddenly need to explain to stakeholders why they weren't positioned when the move was visible. Fear of missing out isn't just a retail emotion. It's institutional. And institutional capital moves in size. This is how mechanical events become momentum events. How rational gaps become irrational extensions. How markets temporarily overshoot any reasonable fundamental value. Because in the short term, markets aren't rational pricing mechanisms. They're voting machines. And when the vote swings, it swings hard. So here's where we stand. Friday, January 17th, close at 89.22. Weekend of January 18th, 19, pressure building globally. Physical markets active. COMEX dark. Monday, January 20th, 9 a.m. Eastern. The bell rings, and the market has to print a number. That number might be $92. It might be 108. It might be 127. Wherever it prints, it won't be random. It will be precisely where buy orders exceed sell orders, where the matching engine finds equilibrium. Even if that equilibrium is nowhere near where Friday closed, the mathematics are building, the behavior is confirming, the signals are aligning, and the clock is running. 65 hours of silence, ending with one number, that might change everything participants thought they knew about what silver costs, and when you actually need it. The Monday gap, silver to open at 150, insiders accumulating before the bell. Friday, January 17th, 2026, silver closed at 89.22 per ounce. A normal weekend for most, but not for those watching the numbers behind the numbers. 14,000 contracts, traded in the final hour alone. While the world prepared for 2 days of rest, institutional money was making a different calculation. 123 million ounces registered, but only 30 to 40 million actually free to move. 33 million ounces due for delivery. In the next 30 days, the mathematics don't lie, and neither do lease rates spiking into the teens, or physical premiums appearing in markets that never sleep. When Monday's bell rings, the price might not climb. It might simply reappear somewhere no one expected. The question isn't if the market will gap. The question is, where will it print that first number? Welcome back to Financial Rewind. You know, there's something we've noticed about the people who've been here from the beginning, the ones who understood that financial history doesn't just repeat, it reveals. If you're still here, still watching, still asking the questions others won't, then you already know why this channel exists. But if you haven't subscribed yet, think of it this way. We're not asking you to hit a button. We're asking you to make sure you're in the room when the next market dislocation is being explained, not after it's already happened. Because by the time the headlines scream, the move is over, and the prepared have already positioned. So, subscribe. Not for us. For the version of yourself that doesn't want to read about what happened, but wants to understand what's happening. Before the bell rings. Now, let's break down exactly what's building behind this Monday open, and why 48 hours of silence might be the loudest warning this market has given in years. There's a pattern in markets that repeats with uncomfortable precision, not daily, not monthly, but in those rare moments when the machinery beneath price discovery starts to fracture, when what the market says and what the market can deliver diverge, and the weekend becomes a pressure chamber, building force with no release valve, until Monday morning, when the valve opens and the market doesn't resume, it resets. January 17th, 2026, late Friday afternoon, silver futures trading at the Chicago Mercantile Exchange, the official close prints at 89.22 per ounce, down slightly from the week's peak in the low 90s. The financial media narrative is predictable: profit-taking, healthy consolidation, traders lightening up heading into the weekend, standard market behavior. Except the final 90 minutes of trading tell a different story. Not the story of a market winding down, but a market positioning. In the last hour alone, approximately 14,000 contracts change hands. For context, one silver futures contract represents 5,000 ounces. 14,000 contracts equals 70 million ounces of notional silver. Moving through the market, when most participants are closing terminals and stepping away. This isn't normal Friday afternoon activity. This is urgency. And urgency on a Friday, before a weekend, before a gap in time where nothing can be adjusted, is a signal. There's a number that matters more than price, more than volume, more than sentiment. It's the number that answers a question most traders never ask. When the contract says, deliver, can you? January 20th, 2026. The market is about to find out. The COMEX silver inventory system operates on a principle most participants never examine closely. Two categories, registered and eligible. On the surface, the distinction seems administrative. In reality, it's the difference between a promise and a delivery. Registered inventory represents metal that can be delivered against futures contracts without additional steps. No paperwork delays, no ownership transfers pending, no logistical friction. It sits in the vault, certified, ready. Eligible inventory is different. It exists, yes, but it cannot be delivered without conversion, without the owner's consent, without steps that take time the market may not have. As of mid-January 2026, the registered category held approximately 123 million ounces, a number that sounds substantial. Until the mathematics are applied, here's where the illusion begins to crack. Not all registered metal is actually available. A significant portion sits as collateral for other positions, pledged to house accounts, locked into hedging structures that would break if the metal moved, held by entities that would rather pay premiums, penalties, anything, than release bars that would expose them to risk elsewhere. This is the concept researchers call free float, the subset of registered inventory that isn't effectively spoken for. Conservative estimates place this free float between 30 and 40 million ounces. Suddenly, the 193 million ounce headline number transforms into something far more fragile. Now, overlay the delivery obligations. January 2026 delivery cycle, approximately 2,995 contracts standing for delivery. Each contract represents 5,000 ounces. The mathematics are simple. 2,995 contracts, X 5,000 ounces, or 14 so now is 75,000 ounces. Call it 15 million ounces due in January. February 2026 delivery cycle follows immediately. Another 3,260 contracts lined up. 200,000 ounces. Call it 18 million ounces due in February. Combined near-term obligation, 33 million ounces. Now compare 33 million ounces due versus 30 to 40 million ounces available. This isn't a comfortable margin. This is what market structure analysts call knife-edge dynamics. One unexpected delivery request, one participant deciding they want metal instead of cash settlement, one hedge fund refusing to roll their position forward. And the system doesn't just tighten, it gasps. Because markets don't operate on total inventory. They operate on accessible inventory. The metal that will actually move when called. Think of it as the difference between having money in the bank and having money you can withdraw. The bank's total deposits might be massive, but if withdrawal limits exist, if liquidity is conditional, if access requires permissions that aren't guaranteed, then the headline number is meaningless. What matters is the number that moves. And here's where behavior reveals more than balance sheets. Normally, futures market participants love time. Time reduces urgency. Time lowers funding costs. Time creates space to maneuver. Time allows problems to solve themselves. So when participants start giving up time, when they begin rolling backward instead of forward, moving from later delivery months into nearer months, that's not normal paper market behavior. That's someone who believes waiting is more dangerous than acting. Market observers have noted unusual rolling patterns in recent weeks. Positions being moved from March and May contracts back into January and February, voluntarily choosing more urgency, Why would sophisticated capital do this? Because they believe the urgency is about to be forced on them anyway. Better to control the timing than have the timing control you. This connects directly to another indicator most retail participants ignore: lease rates, the cost to borrow silver. Normally, lease rates sit in the low single digits, quiet, stable, unremarkable. But when lease rates spike, when borrowing costs jump from 2% to 12%, 15%, higher, someone isn't speculating, someone needs metal. Now, to satisfy an obligation they cannot defer, and when obligation meets scarcity, price stops being a negotiation and becomes a demand. The market doesn't ask politely. It doesn't wait for favorable conditions. It simply raises the price until holders say, "At that number, I'll sell." This is rationing by price. Economics 101. Except it happens in compressed timeframes, and the adjustments aren't gradual. They're violent. So what happens when the free float gets consumed? When 33 million ounces of delivery obligations encounter only 35 million ounces of genuinely available supply, the system has to incentivize metal to reappear from eligible inventory, from holders who weren't planning to sell, from positions that were considered long-term storage. How do you incentivize metal out of hiding? You raise the price, not by dollars, by multiples, until someone, somewhere, decides the number is too attractive to refuse. This is why the Monday gap scenario isn't speculation. It's mathematics meeting behavior. The numbers say the system is tight. The behavior says participants know it. And the timing says Monday is when both facts collide with price discovery. Because here's the reality most participants miss. If everyone quietly rolls forward, the system breathes. If enough players refuse to roll, the system gasps. And right now, the data suggests more people are refusing than the market is priced for. The inventory mathematics don't lie. 123 million ounces sounds safe. 30 to 40 million ounces available against 33 million ounces due. Sounds like a market event waiting to print. And when markets under delivery stress need to print a new price, they don't negotiate, they gap. There's a principle in finance that's supposed to be unbreakable. One asset, one price, arbitrage ensures it, capital flows enforce it, markets depend on it. But sometimes the principle doesn't break, it shatters. And when it does, the reconnection isn't gradual, it's instantaneous and brutal. Weekend, January 18th of 2026. COMEX futures closed. The official pricing mechanism, silent. But silver doesn't stop being silver just because New York goes dark. Markets in Shanghai, still operating. Dealers in London, still quoting. Physical traders in Zurich. Dubai, Singapore, still transacting. And the prices they're printing aren't matching Friday's $89 to close. Physical silver premiums have always existed. The difference between spot price and actual delivery cost, fabrication, transportation, storage, dealer margins. Normally, these premiums are predictable. A few percentage points above paper, stable, rational, explainable. But what's appearing over this particular weekend isn't a premium, it's a disconnect. Reports from multiple international hubs show physical silver trading at effective prices significantly above the COMEX reference. Not 3%, not 5%. Spreads that make traders check their screens twice. Because if the spread is real, then one of two things is true. Either paper is wrong, or physical is irrational. And here's the problem with that assumption. Physical markets don't do irrational. They do necessary. When a manufacturer in Germany needs silver for solar panel production, they don't care what the futures contract says. They care what the dealer has and what the dealer wants. When a refinery in Asia commits to delivery obligations, they don't wait for New York to open. They pay what the market demands. Now, this is the reality of physical settlement. It operates on availability, not theory. So when physical premiums widen beyond historical norms, it's not market inefficiency. It's price discovery happening in the only market still open. And if that discovery is occurring at levels materially above where paper closed, then Monday's futures open isn't creating a new price. It's catching up to a price that already exists. Now layer in the mechanism that's supposed to prevent this. Arbitrage. If silver is trading at $95 physically in London and $89 on COMEX futures, arbitrageurs should buy the cheap paper, stand for delivery, sell the expensive physical, lock in the spread, risk-free profit, market efficiency restored. Except, what happens when you can't get delivery fast enough? What happens when the registered inventory we discussed in Part 2 is already spoken for? What happens when the timeline to convert a paper position into physical bars exceeds the timeline your buyer is willing to wait? Arbitrage fails. Not because traders don't see the opportunity, but because the mechanism is broken. And when arbitrage fails, the two prices don't converge slowly. They converge violently in the direction of scarcity, which means paper doesn't pull physical down. Physical drags paper up. This brings us to another signal most participants overlook. Lease rates, the cost to borrow silver for short-term needs. Think of it as the rental price for metal. In normal conditions, lease rates sit quietly. 1%, 2%, maybe 3% annualized. Boring, predictable, invisible. But when lease rates spike, when the cost to borrow silver jumps from low single digits into the mid-teens, someone isn't engaged in casual market activity, someone is in distress. And here's the cascade. Risk management systems across institutions trigger simultaneously. Every algo monitoring exposure, flashing red. Every compliance officer getting alerts. Every portfolio manager getting calls. You need to cover now. But covering is buying. And buying, when everyone else is forced to buy, pushes price higher, which triggers more margin stress, which forces more covering, which pushes price higher still. And this is called a reflexive cascade. And it's the most dangerous dynamic in markets because it's self-reinforcing. Price rise creates forced buying. Forced buying creates price rise. And unlike normal buying, which responds to valuation, forced buying ignores valuation. It only cares about survival. So yes, a gap can start rationally. Market opens at $118 because that's where sellers appear. Rational, mechanical, explainable. But then the cascade begins. Shorts covering push it to $125. More margin calls push it to $132. Momentum algorithms detect unusual movement, push it to $140, and suddenly the market is trading at levels that have nothing to do with fundamental value and everything to do with structural necessity. This is why the $110 to $150 range exists, not as a prediction, as a plausible boundary for where forced mechanics could push price before enough sellers appear to absorb the pressure, before the cascade exhausts itself, before equilibrium, however temporary, gets reestablished. But there's another element most traders forget: volatility controls. When price moves too far, too fast, exchanges implement circuit breakers, trading halts, widened price limits. These aren't conspiracies. They're designed to prevent system-wide failures, to give participants time to assess, to prevent flash crashes or flash spikes from destroying market integrity. So if Monday opens and immediately gaps to $125, don't be surprised if trading halts within minutes. If the exchange implements a 5-minute pause, if spreads blow out to levels that make execution nearly impossible. This is normal in abnormal markets. And if you're planning to trade during this, you need to understand the perfect execution you pictured on Sunday night might not be available Monday morning. Let's frame the realistic scenarios. Scenario A, small gap with volatility. Opens 92 to 95, surges, then whipsaws violently as traders react. Probability, moderate. This assumes some selling interest appears near current levels. Scenario B, medium gap with follow-through. Opens $100, 110, holds, then pushes higher as shorts cover. Probability, elevated given current structural signals. This assumes sellers are exhausted below triple digits. Scenario C, large gap with new regime, opens 110, 130, doesn't give back old prices, establishes new base. Probability, lower but non-zero given inventory mathematics. This assumes physical paper convergence forces immediate repricing. Scenario D, extreme gap with market controls. Opens $130, $150, triggers, halts, volatility controls engage, probability, low but catastrophic if realized. This is the tail risk scenario where all stress factors converge simultaneously. Which scenario plays out depends on two variables: liquidity and panic. How much metal is actually willing to sell near Friday's close, and how many participants realize simultaneously that waiting is dangerous? Because here's the psychological shift that matters most. Friday's narrative: silver cooling off after strong run, profit taking normal. Monday's narrative: if gap occurs, silver breaking into new regime, shortage pricing. Narrative shifts change behavior instantly. What was considered expensive Friday becomes cheap Monday. What was profit-taking Friday becomes panic buying Monday. And this is where institutional FOMO enters, not retail. Fear of missing out, institutional FOMO. Portfolio managers who were underweight, fund managers who dismissed the physical signals, strategists who assured clients the rally would pause. Suddenly, all facing the same problem. How do we explain to stakeholders why we weren't positioned when the move was visible on the screen? So even if the gap starts as mechanical, even if it's purely about inventory and delivery math, it can become psychological. It can become a stampede, where price temporarily overshoots any reasonable fundamental value. Because in the short term, markets aren't pricing mechanisms. They're voting machines. And when the vote swings, it doesn't swing gently. One final mechanism that matters, the close. Monday's closing price might be more important than the opening print, because the close answers a different question. Was this a panic spike or a repricing? If silver gaps to 118, then closes at 116. The market is saying, yes, we repriced, and this is the new level. If silver gaps to 118, then collapses back to $95 by close. The market is saying, that was temporary dislocation, not sustainable. So if Monday delivers a gap, don't react to the first print alone. Watch the first hour, watch how dips get bought, or don't. Watch whether sell pressure appears or evaporates. Watch the close, because the close tells you whether the market is building a new floor or rejecting the spike as unsustainable. Most participants won't be ready for Monday because they're judging the future, and by normal days. But big moves don't happen on normal days. They happen when normal assumptions break. When paper meets physical, when obligations meet scarcity, when time runs out, and the market has to print a number, whether anyone likes it or not. The opening mechanics aren't mysterious, they're just honest. The matching engine finds equilibrium wherever it exists, even if that's $40 higher than Friday's close, even if that's nowhere near where the textbooks say it should be, because markets don't follow textbooks during stress events. They follow mathematics. And right now, the mathematics are pointing toward Monday morning, when 65 hours of silence end with a single number that might redefine what everyone thought silver was worth. The bell is coming, the order book is stacking, and somewhere between Friday's close and Monday's open, the staircase turned into a ladder. And the ladder has missing rungs. Why would anyone pay 12%, 15%, potentially higher, to borrow silver for a few weeks? Because they need it, need to satisfy a delivery obligation they cannot defer, to cover a short position that's moved against them, to meet a contractual commitment where failure isn't an option. This is the economics of desperation. And desperation doesn't negotiate price. It accepts price. Here's how this connects to the weekend physical premiums. If someone is paying elevated lease rates to access metal, they're doing so because direct purchase in size isn't available at reasonable levels. They need to borrow, deliver, and later replace. But if everyone who needs to replace starts competing simultaneously, the replacement cost spirals, which makes the current lease rate cheap in retrospect. This is the reflexive loop building beneath the surface. And then there's the after-hours activity. Late Friday, January 17th, after the official close, reports of significant block trades executing, 2,200 contracts, then 0.800 contracts, then another 3,000 contracts, all clustering around the $89.40 to $90 range. Let's be clear about what this represents. This isn't retail momentum chasing. Retail doesn't move in 1,000 contract blocks. This is institutional positioning. And here's the strategic calculation behind it. If you believe Monday opens with a gap, if your analysis says the first print could be $110, $120 higher, then paying $90 on Friday evening isn't overpaying, it's insurance. You're accepting a $0.70 premium over the official close to avoid potentially paying $20, $30, $40 more on Monday. The mathematics are simple. The execution is sophisticated. Now ask the uncomfortable question. Who has this information? Who is confident enough in a Monday dislocation to commit significant capital in an illiquid after-hours window? Either they're reckless or they're informed. And institutional capital at this scale isn't reckless. This is where the physical paper divorce becomes undeniable. Paper closed at 89.22. Physical is trading materially higher internationally. Lease rates are signaling acute metal shortage. Block trades are executing above the close. And Monday morning, these parallel realities have to merge. The textbooks say arbitrage prevents sustained price differentials. The textbooks assume arbitrage mechanisms function. But when inventory is constrained, when delivery timelines exceed market patience, when borrowing costs spike, when physical premiums explode, the textbooks become historical documents, and the market writes a new chapter, in real time, with real capital, at real consequences. Because here's what happens when physical and paper reconverge. The adjustment doesn't happen gradually. It doesn't smooth out over days or weeks. It happens in the first print, Monday morning, when the COMEX matching engine opens and has to find where sellers actually exist. Not where they existed Friday, where they exist now. After 48 hours of global physical markets revealing true clearing prices, and if those sellers don't appear until $110, the engine prints $110. If they don't appear until $125, the engine prints $125. If they don't appear until $150. Well, you see where this goes? The arbitrage signal isn't subtle anymore. It's screaming. Physical markets are divorcing from paper, not because of manipulation, not because of irrationality, but because one represents actual metal, and the other represents a claim on metal that might not move. When Monday's bell rings, the market will answer one question definitively. Which price was the lie? Friday's 89.22 paper close, or the weekend's elevated physical reality? And the answer won't come from analysis. It will come from the first number that prints when buyers and sellers meet, and the market discovers what silver actually costs, when you need it, not when you want it. Most people think markets move in lines, up, down, sideways, continuous, traceable, logical. But that's not how markets actually work. That's how charts make them appear to work, because charts can't show what doesn't exist. And sometimes, between one price and the next, there's nothing. Monday morning, January 20th, 2026, 9 k.m. Eastern Time. The COMEX silver futures market prepares to open. After 65 hours of silence, and in those final seconds before the bell, there's a mechanism most traders never think about. The opening auction? Here's how it actually works. During the closed period, orders accumulate. Buy orders stacking at various price levels, sell orders waiting at other levels. The exchange's matching engine has one job: find the price where the most volume can transact, where buy interest meets sell interest, where equilibrium exists, even temporarily. Sounds simple, until you realize what happens when equilibrium doesn't exist where everyone expects it. Think of the order book as a staircase. Each step represents a price level. Each step has a certain depth, a certain amount of liquidity. In normal markets, the staircase is solid, steps are close together, liquidity is thick at each level. You can walk up or down smoothly, predictably. But in stressed markets, the staircase changes, steps get farther apart, some steps disappear entirely, and suddenly you're not walking, you're jumping. Let's apply this to Monday's open. Friday closed at 89.22. In a normal market, sell orders would be layered above that: 89.50, 90 hours, 90.50, 91 Urzlers. Each level providing resistance, each level giving the market a place to pause. But what if those levels are empty? What if the sellers who would normally be at $90 already sold Friday? What if the sellers at $95 don't exist because that metal is already committed? What if the first real sell interest, the first place where substantial liquidity appears, isn't until $110? The matching engine doesn't care about smooth transitions, doesn't care about what Friday's chart implied should happen next. It has one mandate: match the maximum volume at a single price. So if the buy stack accumulated over the weekend is massive, and the first significant sell wall isn't until $110, the opening print is $110, not because anyone decided it should be, but because that's where supply finally appears. This is the gap, not a glitch, not manipulation, pure mechanical function. The market doesn't owe you continuous prices. It owes you accurate prices. And accurate means where transactions actually clear. Now here's where it gets worse, because the gap isn't the end of the event. It's the beginning. Let's walk through what happens in the seconds and minutes after that first print. Scenario. Monday opens, first print, 118. Every short position on the board just took a brutal hit, instantly. A trader who was short at $87, thinking they were managing risk prudently, just watched their loss expand by $31 per ounce. On a 5,000 ounce contract, that's $155,000 per contract. Margin calls start hitting, not in hours, in minutes.